just get a show of hands.
Here.
Okay, great. You guys are here. And you can still see my screen, right? Okay, then just before we get back into things, somebody asked a question about VPN and whether or not it's an application or a logical control.
Yes.
Yes, I have an answer for you. And I did what a lot of people do. Remember when I was answering you, I started by saying with the VPN, would you still need a password to access your control, your applications? It would depend, right? It actually doesn't depend. If we take it a step back, remember we defined application controls as a control that is specific to the application.
Yes.
So is VPN specific to your banking app?
Nope.
So it's not an application control.
Okay. Thank you.
Somebody has their hand up. You're welcome. Somebody's got their hand up. Let's check. Nosipo. If you have a question, you're on mute, but your hand is up. Okay, I take it no question. Okay, moving on, we're going to now discuss business cycles, and then we'll talk about planning and audit. We'll get into audit strategy, audit plans, and then we'll talk materiality. Business cycles. Business cycles can be used interchangeably. Another word for business cycles would be a system description or a business process. So whenever you hear business process, system description, think business cycle. In terms of exam terminology, you're not penalized for whatever terminology you use. They all mean the same thing. So the cycles that we have are the revenue and receipts cycle, the finance and investment cycle, payroll and personnel cycle, inventory and production cycle, acquisitions and payments cycle. So there's a lot of detail that needs to be covered in business cycles. I'm not going to be able to go through all of the detail with you because it's really like it's a lot. But it is very, very important that the things that we don't cover in tonight's session, that you go into your auditing notes textbook and you study your cycles in detail. You won't find the cycles anywhere else other than your auditing notes textbook. So if you don't have an auditing notes textbook, I would advise that you borrow a textbook or buy a textbook if you're able to. You're going to need the textbook to study your cycles. And in terms of passing audit, the chances that you can pass audit without understanding business cycles is very, very slim because they form a huge part of audit. Your test of controls are derived from your business cycles, and your substantive procedures are derived from your business cycles. Evaluating weaknesses in internal controls is also derived from your business cycle. So those are three very big components of your auditing module that are just derived from this cycle. So I hope you guys are understanding how important it is by the fact that I keep emphasizing it and that I haven't moved from the slide as yet. But I'm ready to move along. We're going to start with the revenue. Wait, does everybody know what auditing notes is, the textbook? Hello? Can you guys hear me?
Yes,
Yes, we can.
Yes, we can.
Okay.
I
No,
think
guys,
we
the
can.
silence, it scares me. It really scares me. You need to talk to me.
I think we can see you, but I think some of us probably have forgotten that you said you don't see raising reactions, therefore you need us to talk. So we've been raising a lot of sharp emojis showing that we know what we're talking about.
No, I can't see that. I can't see that. Sorry, once I switch over to the slides, I can't see that.
All right.
Okay,
Sorry,
but thank you.
I needed to ask something. So let's say, for instance, now I'm currently doing my articles, and is it wise if maybe I do a lot of the system descriptions when maybe I'm part of an engagement team. I ask for this part of system descriptions for my benefit in terms of also studying while I'm also working. Is it advisable or
Yes, if you are in audit, you should try to use audit to your advantage. If it's possible for you to request specific sections, request those sections. If it's not possible for you to do a system description, you could still get a lot of benefit from doing the section itself. Because even if you do the section, you still need to read the system description or the business process in order to understand it, right? Because you can't audit what you don't understand. So it's very beneficial. When I was a first year, I was also doing my CTA while I was doing articles, and one of our training managers advised to use audit to your advantage, because that's how it becomes practical for you. And ask questions on the audit. You can use audit as a second lecture.
all right, thank you.
Cool. Okay, everybody has the textbook. Everybody knows which textbook I'm talking about. If you don't have the textbook, you know where to find it. That's what I'm assuming. So I am moving to the revenue and receipts cycle. Your revenue and receipts cycle is a big cycle because it's got quite a few components in it, but it basically deals with the process of a customer who orders and buys goods or services from an organization or from a shop or from a company or wherever. So the cycle would then have things like customers placing an order. Once the order has been placed in the order department, you would then dispatch the goods to the customer. You would invoice the customer. You would record the sale in the general ledger, and then you would raise a debtor. You would receive payment from the debtor. You would record the payment from the debtor, and then you would also do credit management. The credit management part is basically, if you are selling on credit, you want to make sure that your customers are credit worthy. If you guys have store accounts like a Foschini account or a what are the other stores, or a Woolworths account or a Truworths account, you guys had to do a credit application, in order to get that. That's part of credit management. So again, I'm going to keep trying to make these practical examples so that you guys can see the practicality of audit. So, for example, if you are buying on yes, someone is speaking. Why are you laughing at me? Oh, okay. I'm going to assume you're not laughing at me for my self-confidence, and then I'm going to keep going. So, for example, you put an order on Takealot. Put yourself in the shoes of the supplier. So you're going to also need to sort of interchange and move backwards and forwards between being the customer and being the supplier, and try to think on which side who is doing what, right? An order is being placed online. You add items, they go into a cart. Once you place the order, an order number comes out. That number is a unique number. You pay for the order. The goods are dispatched from a warehouse, which is either in Joburg or Cape Town, because it's Takealot. And then they come to you. Or you bought on account, and then goods will be dispatched before you pay for it. And then the money is received from whoever you're paying it to. If you haven't paid, then you go on to debt collection. So maybe you ordered online from Truworths and you used your store card to pay for it, and then come month end, you don't make a payment on your store card. Truworths is going to call you and say, hey, you haven't made a payment. Think about those different departments, think about those different phases of your transaction, and then also try to think about the kind of documents that would be available or that would be used in those functions, in those departments. So documents that are used are things like a customer order. So in an online world, once you place an order, you receive, it says, congratulations, your order has been placed, order number, blah, 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 blah. In a manual environment, maybe you would send an email and you would order some goods, and then somebody would email you back and give you either a quotation or they would give you an order number, but a customer order number would be created. That order number would go to the dispatch department or to the warehouse where those things are being kept. The order number would be linked to a picking slip. That picking slip would also have a number. It would specify what goods need to be picked from the warehouse. So you ordered an air fryer, you ordered a hot air balloon, you ordered a Mercedes-Benz. They go and they pick those things from the warehouse. And then they put together a delivery note. The delivery note will have your address because they need to know where to deliver it to. It will have your cell phone number so that they can contact you about the delivery. It will have its own unique delivery note number so that they can know how many deliveries are being made. And that delivery note number will be linked to your invoice, will be linked to your picking slip, and will be linked to your customer order so that they know that all of these things relate to one order. So there's some form of cross-referencing that needs to take place. At the end of the month, you'll receive a statement. Your statement will have your name on it. It'll have your address on it. It will have the details of the purchases that you made in that month. It will have the balance outstanding. And then in the following month, the balance that was outstanding in the previous month will be a balance brought forward. There'll be a payment. If there's additional items that you bought, those things will be listed. And then again, there'll be a balance at the end of the month. You'll also receive a receipt when you pay. These days, because we're paying electronically, if you make a payment using EFT, I suppose your receipt would be your proof of payment. You'll have a remittance advice, which is also your proof of payment. And a remittance register. You can go to the bank and you can ask them to print for you a register of all your proof of payments. You can get a credit note. If you are returning the goods, then they would issue you with a credit note, which reverses the invoice in the accounting records, and a deposit slip, because back in the day, people would go to the bank and they would fill out a deposit slip, and then they would give the teller money, and then the cashier would count the money using those machines that go, and then they would deposit your money into the bank account. And then you have price lists so that you know how much things cost. But if you think about it in today's technological age, you can see the prices of the things that you want to buy on the website. Any questions on the documents that you would find in the revenue and receipt cycle and sort of their purpose and functionality and how they link to each other? I hope I was able to paint a picture that is picturable.
I think we've received hands which are showing that people are understanding. So on behalf of them, I think everyone understands, unless then someone can just unmute themselves and ask.
Oh, thank you. You are so kind. What is your name?
It's Anele Mbenzi.
Anele. Thanks, Anele. You're very kind. Spokesperson of the class. Okay.
Hello.
Hi.
Hi, can I please ask a question?
Yes.
So I just want to find out if maybe you're using a certain system to deal with your customers, né? And on the system you are able to like delete these delivery notes or credit notes. Will I consider that as a weak controls or on the system if the system allows you to delete instead of editing?
Definitely. Even if it allows you to edit, it shouldn't allow you to edit. Once a number has been registered, that number should remain on the system.
Ours allows us to delete, but okay, fine. Thanks.
If it allows you to delete, it probably has a mitigating control, which is an exception report. So you can draw a log of what was deleted. That is a control.
Okay.
So you need to be able to trace what was deleted, either by not being able to delete it at all, which is first prize. But if a system does allow you to delete, then you need something like an exception report where you can look at the log and see what was deleted.
Okay.
But there has to always be a record of it somewhere.
All right. Thank you so much.
Hi, Onati.
Hello.
Oh, I'm good. My question is not exactly on the source documents, but I would like to ask if our revenue cycle is somehow linked to our IFRS 15 when we are performing these substantive procedures. And if
Oh,
the
it is definitely linked.
So how then do we really link the two in terms of the standard itself and the cycles? How do we then respond to our questions in an exam scenario?
For example, maybe you're sitting with a cycle where they are VAT registered and they record their transactions, right? Then it tells you that the accountant records the full transaction in revenue and records the full amount into the receivables. What does IFRS 15 say about revenue? You only record the amount that you expect to receive. That VAT doesn't belong to you, it belongs to SARS. So it's non-compliance with the accounting standard if you record the full revenue plus VAT in the revenue account. Does that make sense? Have I answered your question?
Oh, yes, it does make sense. So then, okay, isn't we have those 5 steps in IFRS 15? So I really haven't come across any question on that, but maybe I was just thinking that maybe in the future when we go through all that, I'll be able to come across such questions. That's why I was asking. So is
Oh,
there
you
any...
mean forming procedures using the 5-step model?
Yes, does it link to our revenue cycle or it's a totally different thing and the questions are asked in different ways?
I don't want to say it's a totally different thing because it's not a totally different thing. It's part of revenue. IFRS 15 says you must allocate a transaction price, right? Your allocation of a transaction price is the amount that you expect to receive. That is the amount excluding VAT, excluding discounts, etc. So if you are in a situation where a customer is paying, but they're paying a discounted price, you don't include the discount in the revenue because IFRS 15 says when you allocate the transaction price, you don't include that.
Oh, okay.
So from an audit perspective, when you are auditing it, if your client is doing that, that means that it's not accurate. So from an assertion perspective, you need to formulate procedures that test the accuracy
All right.
of the revenue that's being recorded.
Okay.
Another assertion that you have is presentation, right? IFRS 15 also has specific presentation and disclosure requirements. If your client has not disclosed certain things in terms of IFRS 15, when you design your procedures or when you comment on whether or not they are in compliance, you will use IFRS 15 as a basis.
Okay. Okay, thank you.
Okay. Your okays don't sound concrete, but I'm really hoping that I've answered
Okay.
your question.
I now have an idea. Thank you so much.
Okay. Any other questions?
I have a question. Hi, Unati.
Mhm.
So
Hi.
in an exam technique, would you say that when we maybe like identifying weaknesses, should we always try to include all of these source documents that you've listed here?
No, you only include the source documents that are relevant to the weakness.
Okay, I'm not really doing so well in this cycle question. So I wasn't sure if I'm missing, maybe is it that I need to go back to the textbook or what I'm actually missing. So I thought maybe this would help.
It's about going back to the textbook, right? But then in going back to the textbook, also visualizing, making things practical. So for example, think about COVID days, right? When we were allowed to go to the shops, I think we were maybe locked down level 3 or something. You would get there and there was a register next to the security guard, right? You had to fill in your name, your surname, where you stay, blah, blah, blah. Have you been in contact with someone who has COVID, etc., so that they could track you, right?
Yeah.
And then once you walk in there, you would take your basket. After you take your basket, you would walk through the aisles, select the items that you want to purchase. Once you finished shopping and selecting the items you want to purchase, you walk to the till, right? When you get to the till, there's a cashier who is sitting there who has a computer in front of them and a scanning machine, right?
Mm. Yes.
The cashier will then take your groceries as you've unloaded them onto the till, and they'll scan them one by one. As they scan them, the machine is automatically adding the total together, right?
Yeah.
Then at the end, the cashier will tell you that your total groceries have come to 3,250 Rand. Then they'll ask you, are you going to pay cash or card? Then if you're paying cash, they take the cash amount, they open the cash register, and they give you the change as per what the system is showing. Or they activate the card machine for you where you can tap, insert, or swipe your card. They'll then give you your groceries in a plastic bag with a till slip, right? Your till slip has a number on it. It's got a lot of details and things on it. I'm sure people don't look at their till slips, but you should look at it. And then you walk out the store. As you get to the store, there's a security officer who maybe wants to sign your slip. Before you go out, he'll sign your slip, look in your bag as if he's actually checking the groceries, but he's not. And then he signs it, and then you walk out.
Yeah.
Right?
Yeah,
And
I
how
think
many controls are you seeing in that process?
yeah, there are quite several. But you know, as you are talking now and you're saying visualize, I think I'm just reading the question just to finish reading time. I think like the way you were saying it, I'm not visualizing it. So now as you were talking, like I was visualizing the person walking. So I think I have my answer. I think I'm seeing where my problem is. Thank you.
Okay. Can I move to the next slide?
Yes, you can move.
Yes, you can.
Thank you. Then the stages that are involved in the cycle, or rather the financial statement line items, it's stages and financial statement line items. Your financial statement line item is revenue, and the stage, I suppose, or the type of function it holds is that it is a transaction. And then you have trade receivables, which is a line item, and its function is that it holds your balances at year end. And then you have bank and cash, or cash and cash equivalents, whatever you'd like to call it. And those are where your transactions go in and out as they relate to revenue and receipts. As you sell things and you receive money from customers, it goes in and out of your bank account. Cool. Then when it comes to cycles, we always have to consider fraud. So when we go through all the cycles, we will consider fraud in the cycles. Fraud can occur by management creating fictitious sales, or creating fictitious debtors. The aim of this would be to increase profits or to boost the asset ratios. Or it could be in the reverse. They could understate sales, which is a completeness issue, in order to not pay income tax. Because remember, you pay income tax based on your profits. And if you want to reduce your profits, you would reduce your sales. They could also understate the bad debts allowance, which is an IFRS 9 concept. So again, your standards are coming in. IFRS 9 has a expected credit losses model that is supposed to be followed. And if they're not following that correctly, you have a risk on accuracy, valuation, and allocation. This can be done to improve profits, to boost your assets, and the related ratios. Or they could manipulate the revenue recognition by pre-invoicing. So raising sales before those sales occur. So it's not fictitious sales, it's just prematurely recognized sales. For example, if something was supposed to be recognized as deferred revenue, you've received the money already, but you've not performed or satisfied the performance obligation, which is an IFRS 15 concept. and then you recognize revenue. IFRS 15 says you can only recognize revenue once you perform your, or once you satisfy the performance obligation. So if you're recognizing revenue before you satisfy the performance obligation, then your revenue has not occurred. And then you have misstatement. Where this can happen is where you pay for goods before you receive it. So like with Takealot, if you're ordering online, you've paid for it already, you've gotten an order number, you're just waiting for those goods to be delivered to you. Until Takealot delivers those goods to you, they've not satisfied the performance obligation, and so they cannot raise revenue. They would have to raise deferred revenue. Once that has been, once the performance obligation has been fulfilled, then they can recognize revenue. Happiness. Is the link to IFRS 15 making a little bit more sense? Is that there was a shaky yes after the question was asked? Is that shaky yes getting a bit more concrete?
Yes, I think.
Yeah.
Okay.
Oh,
it's still shaky. Yes. I'm trying. Somebody wants to ask. Go ahead.
Can I ask? So, for instance, going back to that scenario we were talking about here about ABC Limited. So, let's say, for instance, in that scenario, they said the company was on headlines for. I can't remember it correctly now, but that
it said for accounting irregularities.
Yeah. So, and now they're saying there's this part of cycle, the revenue cycle. Is it correct if I take that information from the background and I apply it here? For instance, I'm saying management have a questionable integrity, therefore they can overstate sales just to maybe meet the listing requirements of the JSE.
Okay, so I wouldn't say that they would overstate sales, because from the scenario that we read, there's nothing that indicates that sales was the problem. It just says accounting irregularities. It could be any line item.
Okay.
So I wouldn't raise a risk at the assertion level, which is what you are trying to do now.
Okay.
I would raise the risk at the overall financial statement level, because it says accounting irregularities, which is broad and it means it can be anything.
Okay. Okay, now I get it. Thank you.
Cool. Good question. Any other questions? Okay. Other forms of fraud are not necessarily manipulating financial statements. Other forms of fraud can be with misappropriation. So theft is a form of misappropriation. Arranging for customers to pay at unauthorized reduced, that should be prices, sorry, at unauthorized reduced prices. You know how you get those people maybe in Pick n Pay or Woolworths or wherever, when you're shopping over the big seasons, over Easter and Christmas, they'll come to you and tell you that they've got employee discounts. If you meet them at the back of the store, they'll buy you your groceries using their employee discounts. That's a form of misappropriation of assets, and it is a form of fraud. So it doesn't happen with necessarily manipulation in the financial statements, but it does affect the financial statements. Then theft of goods in the dispatch area, not paying VAT, so that's non-compliance. And then making invalid adjustments to your accounting. Okay, so that is the revenue and receipts cycle. That's the portion that I've covered. Are there any questions on the revenue and receipts cycle?
I just have one in terms of fraud. So let's say the scenario is I'm an employee at your company and you're selling computers, and then a customer comes, they're looking for a computer. So instead of selling from the company's equipment, I tell the customer that I have somewhere you can get it for free, and I contact someone that I'm working with, and you get to buy that computer from that person, not in a formal way, not a store, maybe meet in a parking lot and make that transaction. So is it still fraud from the employee's perspective?
No. Remember, fraud has a triangle, right? What is the fraud triangle?
I can't remember, sorry.
Opportunity,
Ask your question. Yeah, opportunity.
rationalization,
Yeah.
I think the last one should be incentive as well.
Yeah, incentive.
And
Okay.
pressure.
So pressure. So rationalization / pressure, right? And then it is to do what? In order to do what? Remember when we talk about material misstatement, in audit, the objective of an audit is to express an opinion that financial statements are free of material misstatements, either due to error or fraud.
Okay.
Right? So when we talk about fraud, we're talking about misstatement in the financial statements. So how does that you've just described cause misstatement in the financial statements?
Okay, now I get it. I think I understand it now.
It doesn't affect the presentation. You just have a bad employee. You have a business risk where your employees are actually robbing you of customers.
Okay.
That's the only thing that they're doing. It's reputational damage, I suppose, if you want to. I think that's a nice way to put it. I don't know. Maybe someone has a better word, but it's got nothing to do with my stock. No one is stealing my stock. No one is stealing my money. No, so everything is fine on my side. I've just lost the customer because I have a bad employee. It's like an employee who's rude. Oh, yeah, who's rude to customers. Customers will just turn around and walk out. It's not an audit risk. It's just a business thing.
All right.
Cool.
You know, I had a question and actually answered myself, but I'm not sure whether I'm right or not. Okay? With regards to fraud and theft, normally we would look at it at the perspective of someone that is involved in management, right? But then I said to myself, with regards to the theft now, the reason why we're looking into employees or whoever position that particular person may have within the city is because of, for instance, if inventory is booked within the system immediately at the receiving day or whatever, and then it gets to the premises and then it gets stolen in the premises, we are saying now the inventory that is being recorded, it's stated because this part that is stolen. There is also looking into employees as well, or there is why employees theft is significant this time.
It's significant all around. I mean, significant refers to the impact and the likelihood as well. But the fact that you've registered it in your books as something that you have, and then when somebody opens your warehouse, it's not there, it means your financial statements are materially misstated.
Okay, so it doesn't really depend on whether it's someone that is management, as long as the actual inventory or whatever stock we would have, it differs to the inventory that we have in the books as it's a misstatement.
Yes, fraud can be perpetrated by anyone. The only time where you are specifically looking for fraud that is perpetrated by management is when you want to report an RI.
Okay, makes sense.
But fraud can happen at any level. A cashier can steal 100 Rand. Okay. I'm going to move on to the acquisition and payments cycle, unless there's any other questions. Okay. Acquisitions and payments. this is your mirror opposite of revenue and receipts. Because remember, on the one side, you're receiving stuff. Now, or rather you are selling stuff. Now imagine yourself on the other side as somebody who is buying stuff. So the cycle is about acquiring goods, and you've also got to think about it, like I said. So previously, you put yourself in the shoes of the supplier, right? We said we're going to think about ourselves as being Takealot. And then I said at some point you need to jump back and forth. Now you're jumping to the other side, and you are now the customer who is purchasing from Takealot. So the functions in the acquisitions and payment cycle would include ordering the goods, receiving the goods, recording of your purchases, which is the actual acquisition, payment preparation, and then the actual payment and recording of that payment, which is the accounting function. So for each of those departments with those functions, there's going to be different documents that are being used and different employees that have been designated or tasked or employed to perform those specific functions. So you're going to need a requisition, which is the opposite of your order. Then you'll have a purchase order form. You'll have a supplier's delivery note, which is the delivery note that you had on your revenue and receipts cycle. Then you'll have a goods received note. So once the acquisition has been received, you'll need to sign the goods received note as evidence that you've received this thing that you've purchased. Then there'll be a purchase invoice, which you need to use to generate a payment. There'll also be credit notes generated if there's any goods that are being returned. I suppose in this scenario, it would be a debit note, not a credit note. And then you'll have creditors statements, which are going to show, again, your balance brought forward, if there's any transactions, any payments that have been made, and then it'll show you the balance carried forward, which will be the balance in the statement of the next month. And then you'll have a remittance advice, which is your payment advice. In terms of financial statement line items, you've got purchases, which is very commonly known also as cost of sales. Not to say that you're only purchasing inventory items. You can purchase assets, being property, plant, and equipment. You can also purchase things like stationery. So your purchases would be, I suppose, general assets. It would be cost of sales, and it would be operating expenses. And those are all transaction line items with the exception of your general assets. Then you'll have payments. Those payments would be going through your bank statement. So again, cash and cash equivalents. And then you'll have trade payables, which is your balance at year end, to show how much you owe based on the transactions and the purchases that you made. Then when we get to the fraud part, management can manipulate account balances. They can not disclose trade payables, so you can have a completeness issue. For those who do auditing who are trainees, you would probably have heard of unrecorded liabilities test. Those would be things to detect understatement. And then from misappropriation side, employees can order things that they would end up using for their personal use and then make the company pay for that. Something as simple as having a work phone and use private phone calls if it's against your work policy. So if your work policy says you can't make private phone calls using your work phone, that's a misappropriation of assets because you're using something that belongs to the company to do things that have nothing to do with the company. Even using your work laptop, if it's against company policy to use your work laptop for personal use, if you're using it for personal use, it's a form of misappropriation of assets. Making fictitious payments, so paying suppliers that don't exist. You would have seen many scandals of those in the news. And then making VAT claims for expenses that are not necessarily taxable supplies. That's also a form of misappropriation. And then theft of goods at the receiving stage, which is exactly the example that somebody gave us just now. Any questions on the acquisitions and payment cycle?
Unathi,
Mm-hmm.
you know how you would have, especially on this acquisition and payment cycle. So let's say you have someone that is ordering the material, whatever goods that is needed, right? A perfect cycle would say there's an ordering check. He does whatever with the requisition, checks that whatever that is ordered, it's being required, and compares whatever that he needs to compare. And then you would now have a senior or a manager in the ordering department that reviews what the ordering clerk has done, right? Then you would get a question now that says a manager in the ordering department is actually the one that received the requisition from the production or whoever that issued a requisition, and then is now the one to do ordering of that particular thing. So there's no some sort of reviewing of what that ordering manager is doing. So for the fact that it's an ordering manager that is ordering, there should still be someone that reviews him or her, right? Isn't it?
Yes.
Oh, okay. Because I feel like they're trying to wave away the fact that there should be a review that is happening just because of it's a production manager or it's a manager in that particular department.
Yeah, it's a weakness. It's a weakness in the control. There's a lack of review over the orders that are being made.
Regardless of whether it's a manager that does that.
Yes.
Okay.
Somebody has to review it.
Okay.
Even in a group structure, let's say, or no, not a group structure, sorry, in an organizational structure, you'll have, remember how I explained, you'll have an accountant, you'll have a financial manager, you'll have a senior manager, you'll maybe have a group, an overall group financial manager, and then that person will report to the CFO, right?
Yeah.
Yeah, so let's say maybe it's the responsibility of the accountant to put together the GL and close off the trial balance. Then it's the responsibility of the finance manager to review that trial balance and then populate financial statements. Then it's the responsibility of the senior manager to confirm that, you know, the accounting policies and stuff are correct. Then the correlation of the financial statements then lies with the group financial manager. After the group financial manager has put together all the financial statements with all of the adjustments and they are happy from that perspective, they give it to the CFO to review. It was made by the group financial manager, a manager, but it still needs to be reviewed. So the CFO will look at it.
No, oh, okay. But then, like, if in terms of me answering the question, I could just say that there should be like a senior.
You should say senior personnel.
Oh, yes. Okay.
It becomes tricky if they haven't given you the job titles of the people. Use words like junior personnel, senior personnel, things like that.
Okay.
Okay. Any other questions before I move on to the inventory and production cycle?
Hi, Nati.
Hi.
I'd just like to say that to me, it occurs that the acquisitions and payment cycle would also be in a function of accounts payable, right? And
Yes.
in accounts payable, we also would receive credit notes and not necessarily issue out debit notes, because in a case where maybe a supplier would deliver something that is defective, then we would then also request a credit note from them to send it through. So not necessarily a debit note per se, but then they would have to send through a credit note to show that that transaction is cancelled or reduced.
Thank you for that. Your accounting is better than mine. The terminology escaped me. But yes, debit credit note, reverse invoice. But the point is the reversal of the sale or the reversal of the purchase.
Yeah.
Thank you very much. Any other questions? Concerns, comments, considerations? Okay, can we jump into the inventory and production cycle?
Yes.
The inventory and production cycle is one of the cycles that also links quite heavily back into your accounting because inventory is a function of IAS 2. Apart from it linking back into IAS 2, it also links back to management accounting because of the costing element where you have standard costing and what's the other one? There's standard costing and there's another costing. The other costing is easier than standard costing. I think it's process costing. But those are the different disciplines that then link back into inventory. So when people say you can't audit in isolation, this is what they mean. You need to be able to see how all the different disciplines are linking into what it is that you are auditing. So the cycle is about inventory, which will also include the storing of the inventory, which is the custody and safekeeping for goods that are purchased and then held for resale, or for goods that have been manufactured and are held as finished goods, or where it can be work in progress. Yes, it is. It's process costing. I think it's process costing. And then the recording of that process, how you're producing your goods, your manufacturing, from your raw materials to your conversion to your finished goods. Also thinking constantly, I suppose, from a risk assessment perspective of what it is that could go wrong. On your financial position side, you're sitting with inventory. Inventory links back to a balance. So when you're thinking of what could go wrong, you're looking at risks that relate to your account balances. And then from a statement of, it should actually be statement of profit or loss, because cost of sales sits in the statement of profit or loss. The substantive procedures that would relate to cost of sales, those sit in the acquisition and payment cycle. Remember how I told you that those transactions could either be purchases of general assets, it could be your cost of sales, or it could be your operating expenses. The cost of sales leg sits in your purchases cycle, and then your inventory leg sits in your inventory and production cycle. So it's one concept that kind of splits over 2 cycles and also splits over 3 CTA disciplines. I hope that makes sense. Came a little bit jumbled out. Are we all still on the same page?
Yes, ma'am.
Who's my spokesperson? Okay,
Yeah,
great. Thank
yeah,
you.
we're still here.
Okay, great. The documentation used, good received note, that would be when you're purchasing your raw materials. When it arrives, you've got to sign your goods received note. You'll have material components, requisitions. So people in different departments, somebody used an example where a manager is requesting something to be purchased. So you'll have different requisitions from different departments. Then you'll have manufacturing and production schedules that will state at which point your inventory is in its conversion process. If you're still in the raw material stage, if you're in the conversion process, is your product 50% converted, etc. How much material has been used in order to get it from 0% to 50% conversion. You'll have job cards where people will clock in and out and log the work that they're doing in terms of the production. You'll have a production report showing you how far you are, a costing schedule that's going to show you how much has been put into your production at this point. Then you'll have a transfer to finished goods note where you take your things out of work in progress and you move them into your finished goods. By that logic, you would also have a transfer from raw materials into work in progress. A picking slip, delivery notes, an inventory sheet, which would list your total inventory. And I suppose it would also be categorized in terms of raw materials, work in progress, and finished goods. and then an inventory adjustment form. Inventory adjustments would be where you've got any normal losses or abnormal losses or any inventory write-downs, obsolete goods, things like that, that you need to account for. Or if you're using, what is that thing? Not FIFO, weighted average. If you're using weighted average and you need to put adjustment into your stock, you would use an inventory adjustment form to adjust your stock according to your weighted average. Any questions on the inventory and production cycle?
I think we could.
Okay. Moving to payroll and personnel. Payroll and personnel is the HR function where people come to work and people get paid at the end of the day. That is an outflow of funds from the business, and it goes between two phases, which is salaries and wages. Typically, salaries is for full-time employed staff that receive a fixed amount at the end of the month, and wages would be for contract or casual workers that come and receive a weekly wage. From the statement of financial position side, you're sitting with bank and cash, which is your cash and cash equivalents. You're also sitting with accounts payable. Accounts payable is where you've got to generate your provisions for leave and unclaimed wages. You've got to pay over third parties like SARS, pension fund, and medical aid. Then in the income statement, you're sitting with operating expenses, which is employee costs or wages and salaries. That'll include any pay-as-you-earn deductions. It will include UIF, SDL, medical aid, pension fund, those third-party payments. Then the functions or departments would be personnel, which is HR, timekeeping, where you would store your timesheets, payroll preparation in accordance with your timesheets, and then the payment preparation and payout, and any deductions, whether you've got garnishes or medical aid deductions, third-party deductions, all of those things go through your payroll. The documents that would be used in that cycle, your employee contracts, which would stay in your employee file, a payroll amendment form that can happen if there was an error in your payroll, or if you receive an increase letter and now you need to get paid more, you need to amend the payroll for that. You'll have a list of employees, clock cards for people to clock in and out, batch control sheets, which would hold your timesheets, and then a batch register, which would say maybe, these are the timesheets for January, February, etc. Deduction tables and returns that would be tax related and any other third-party deductions like in your medical aid tables and things like that. Payroll, which would be your wage journals, pay packets. People don't really use that. I think they still use it maybe in construction. They give people envelopes at the end of the week. Pay slips, a salary advice, which is also a pay slip in my opinion. Then unclaimed wage register. So if somebody didn't pitch up on payday to come and collect their pay packet, you've got to keep your unclaimed wages. And then a recon for wages and salaries. The reason why you need a recon is because your payroll is normally kept in a system that is separate from your accounting system. So you need to reconcile what's in your payroll system against what is in your accounting system to make sure that your general ledger and your trial balance agree to your payroll system. Any questions on payroll? Okay.
No.
Moving on to finance and, sorry?
Hi, Unati.
Yes.
Yes, I do have one question relating to pay as you earn. Would it be more appropriate to address it under the payroll cycle, or should I move it to the acquisitions and payments since it relates to a payment made to a third party?
No, it's payroll related.
Oh, okay, thanks.
Okay. Finance and investment, that deals with your broader other areas that we haven't dealt with yet. So all your other assets that are not inventory, that are not trade receivables, all your equity items, all your liabilities that are not trade payables, or payroll related things, which are also, okay, no, not trade payables, would be other payables. So things like your provisions and your loans, those things would form part of your finance and investment cycle. Issuing shares, borrowing money from the bank, buying property, giving long-term loans, investing surplus funds, capital employed, which would be your equity. So if there's a capital contribution from shareholders, that would sit in finance and investment. And then any non-current assets that are in your financial statements. Excuse me. Then the characteristics of the finance and investment cycle is the fact that there aren't a lot of transactions that go in there. It's not like with the others where you can put out departments and things like that, because it sits with many different areas. Also, the transactions are usually quite material. I mean, if you're going to buy property and stuff, it's large transactions. It's not like when you're buying inventory. Legal and regulatory requirements. Sometimes there's Companies Act requirements. I mean, if you're buying large assets or if you're selling large assets, Companies Act actually has requirements around that. Sometimes your MOI will restrict you in terms of the decisions you can make in terms of issuing shares or giving out loans and things like that. So when it comes to that cycle, your procedures will be centered around legal and regulatory requirements. So when they ask you to provide procedures in terms of the Companies Act for a loan, it's sitting in your finance and investment cycle. Non-routine internal controls, so things that don't happen every day. Again, you don't buy buildings every day. And then there's non-standard documentation, which means there'll be contracts and things. So not these sequentially numbered invoices or picking slips or stuff that all looks the same. For purchasing a building, you'll have a different document than when you purchase shares or when you invest money in a long-term deposit account or whatever. Risks in the cycle is that because it's long-term, people don't check those things very often, and so it's very easy to manipulate those things. If you've got investments where you could be earning interest, if you're not recording that interest because it doesn't happen all the time, there's a risk from error that you could be understating your assets, or the reverse, if you've got a loan and you're not recording the interest, things like that. Fraud would be creating assets that don't exist, not recording liabilities that you've got, not valuing your stuff correctly. So if you've got long-term liabilities, if you're not discounting them and recording them at their amortized cost, if they're recognized at amortized cost, PPE and things like provisions, not putting in provisions that need to go in there, provision for bad debts, rehab provisions if it's a mining company, things like that. Then making use of company assets for personal use, another form of misappropriation of assets. Any questions on the fraud and on the finance and investment cycle? Okay, I want to run through. Then we've got deficiencies, which can happen in all of the cycles. Your deficiencies would exist when you've got a control that is designed or is designed in a way that it is not able to fulfill its objective, which is what we discussed earlier. And then you can also look at whether or not that control is significant, or that deficiency is significant or not, because one's deficiency on its own might not be significant, but if you combine those deficiencies, they could actually create a significant control deficiency. Then some examples would be fraud, which is perpetrated by senior management. There you would need to raise an RI. Any deficiencies that were communicated by the auditors in the prior year that management has not corrected, those could be deficiencies still again in the current year. Failure by management to report on any significant risks, any restatement of previously issued financial statements. So if you've got a restatement, then you automatically have a risk that in the current year, maybe something is also wrong. Auditors need to communicate their risks as well as any deficiencies that they've identified in the system to management. If you guys are in audit, you probably have something called a management report or a report to those charged with governance, or a findings report, something like that. Your deficiencies would be communicated in there. Management would then have a chance to respond to those, and then you would be able to assess based on that whether or not it's going to affect your opinion, whether it affects the work that you rely on, whether you're going to test controls or not, whether you're going to go fully substantive, and that speaks to your audit approach, which I'm hoping we will be able to touch on still today. We are very quickly running out of time. Exam technique for business cycles. You would need to identify weaknesses in the system. If an internal control has been performed incorrectly, or a control that should be there is not there, then you've got a weakness. Once you've identified the weakness, you need to link that to a risk. So you ask yourself, if that thing is done incorrectly or it's not there, what could go wrong? Then you've got your weakness, you've got your what could go wrong, and then you need to say, okay, so this is what we do in order to fix it. So your structure when you're thinking about this is to first identify the weakness, assess the risk, and then apply a recommendation. A quick example. John is responsible for the maintenance of the fixed asset register of the company. He's also responsible for preparing a reconciliation of the fixed asset register to the general ledger on a regular basis. He also records all transactions and purchases of sales of fixed assets in the accounting records. And John signs all documents and reconciliations that he prepares. The required says, identify the weaknesses from the above mentioned scenario. What weaknesses do you guys see? Very quickly.
There's no segregation of duties. John does everything, he prepares and then he signs for it. So if he did an error, no one else picks it up. He signs off his error is correct.
Okay, so now we've identified the weakness, right? So after we've identified the weakness, what are we, okay, we've also spoken about what could go wrong. There's no one who would pick it up, right? So what is the recommendation? Recommendation, what should they do? Yes,
I think
please.
they should hire. I recommend that they should hire different people that are actually competent to do the different responsibility. Like for example, the maintenance of the fixed rate. If John is responsible for the maintenance of a fixed register, somebody else should be responsible for preparing reconciliation of the fixed asset register, but it must be competent to do so.
Yes, and there should be senior personnel to review. And then just be careful when you make recommendations that a company should hire more people, you must also consider the cost. So when you say that, you should say, if practical, additional staff should be employed. So just be careful, put that little caveat in there and say, if practical or if cost effective, additional staff should be employed. Alternatively, another member of staff should review.
Okay, so if I want to say, if I also put the other member, can I still say must be competent enough or have the skill to do so?
Yes, you can say that.
Okay, no, thank you very much.
Okay. Cool.
Unaki,
So that's the response. Yes.
while you're still there, ne, let me say, you're gonna say there's a problem of segregation of duties, ne? Is it a tautology if you come back and say how to mitigate it? You'll say you'll have to segregate duties. Is it a tautology?
It is, but no one's going to penalize you for it.
They're still gonna give you a mark, ne? It's making sense.
Yes.
Oh, okay.
Yes.
All right, thanks.
It would just be English. You would say there's a lack of segregation of duties as there is no additional person to review John's work. An additional staff member should be appointed to review John's work or to, yeah.
Remember, you have to improvise. You don't have to hire somebody. So you can just say you can
Yes.
set it within there and then maybe talk about the
Yes.
senior member. Okay.
Yes.
Oh, Natasha,
Yeah, you're
I
just
have a
giving a
question.
recommendation. Yes.
Now, what happens in like in a small company where maybe the accounting team is like made up of 3 people?
Yeah, that's why I say
Or,
when you give a
or one
recommendation, you
person,
must
let's
say
say
if
one
it's
person.
practical.
Okay.
Sometimes it's not practical, right? And then if it's not practical to do so, the auditor needs to assess the impact of that risk on the audit. Do I need to perform additional procedures? Is there something else that I need to do in order to mitigate this risk? Is it even possible for me to mitigate this risk? And remember also, this is at a control perspective. So if at a control level, you're not happy with the controls, then the ISA says, if you cannot place reliance on controls, you don't test controls, then you go fully substantive.
Okay. Okay. Thank you.
And
Okay.
it's giving you a, what do you call it, inherent risk as well.
Yes. Yes. Yeah, remember at this point, we're assessing risk. We're just trying to see what impact do the factors of this organization, after understanding the entity and its internal control environment and its financial reporting framework and the regulatory environment in which it operates, what does that have an impact? Like, what impact does that have on my audit? Now that I understand what impact all of that has on my audit, I move into planning my audit. So putting together my audit plan and my audit strategy, right? So we spoke about understanding the entity and its environment. We spoke about understanding the internal controls. And then we've identified and we've assessed risks. The next thing would be your planning materiality and your overall audit strategy. What we're going to do now in terms of explaining the work, I'm just going to flip the two around. I'm going to do materiality last because it's a very small section. So now that I've assessed risks and I know what the risks are, I'm going to put together an audit plan and an audit strategy, but we didn't discuss risk at OFS and assertion level. Let's quickly do that. Sorry, I'm jumping the gun here. I think it's because I'm under pressure because we've got no time left. Okay, so the risk of material misstatement at overall financial statement level. That would be risks that are pervasive to the financial statements as a whole. Somebody asked a question about the revenue and it being misstated because of those accounting irregularities. And we said that the accounting irregularities actually give you a overall financial statement level risk. So when it comes to overall financial statement level risk, I would recommend that you flag your ISA 315 revised appendix 2. It'll give you examples for conditions that can give rise to material misstatement, as well as the inherent risk factors. In terms of figuring out whether you've got a risk at overall financial statement level or at assertion level, you need to ask yourself, does this specifically affect a financial statement line item, like revenue, for example? If it does, then it's an assertion level risk. If it affects more than one or not a specific line item, then it's a financial statement level risk. Does that make sense?
Yes, it does.
Yes, it does.
Cool. Then I've just got a quick comparison of business risks. So some business risks can be audit risks and some audit risks are not business risks. So the two are not mutually exclusive, but a business risk can be an audit risk, but not all business risks are audit risks. Then these are conditions that give rise to audit risks. This is what I said you guys should flag in your ISAs. I also had another example. I'm just trying to see. Okay, it's a quick one. Salvatore Limited is listed on the JSE, operating in construction. The company has 9 subsidiaries in 9 African countries. Sorry, the company has subsidiaries in 9 African countries and has recently changed their accounting system from Oracle to SAP. Identify the audit risks at the financial statement level. Can you guys give me a few? Let's maybe just do 2.
I think the first one is changing accounting systems did they bring the correct balances in place?
Perfect. Next one.
There is also a risk of non-compliance with laws and regulations if the company is operating in 9 countries, so there may be complications of international laws and regulations that may lead to non-compliance to some laws and regulations.
Also perfect. You guys are passing auditing this year, I can see it.
And
Okay.
complexity of the structure of business.
Yes, that can also be a factor because they've got subsidiaries. If the subsidiaries are not properly consolidated.
So should I assume that if the company is listed to JSE, that there may be a risk of material misstatement due to the management of the company may manipulate some financial statement to keep up with the JSE laws and regulations to keep, to maintain the listing or to keep on being listed. So they may manipulate the figures to meet the listing requirement and also to attract more investors.
Yes, but it's not an assumption, it's a fact.
Or should I say that if the company does JSE, or should there must be factors that indicating that?
The factor is the fact that it is listed on the JSE.
Oh,
so because it is listed in the JSE, remember we are doing risk. Risk means what could go wrong.
Okay.
Not what will go wrong, what could. It's a possibility.
Oh, okay, I understand. So I'm right. I'm correct.
Yeah. Except that you're not assuming. It's a fact that it is a risk. So you're not assuming that there's a risk. It is a fact. It is a risk. It is something that can go wrong. The likelihood of it going wrong is something else.
Thank you. I understand.
Cool. Then when we respond to risk at the overall financial statement level, the ISA says you need to emphasize to the engagement team that they must maintain professional skepticism, so they shouldn't take everything at face value. Assign experienced staff members to more complex sections, use experts, provide more supervision where it's necessary, incorporate elements of unpredictability. If you normally, if you normally don't sample for trade receivables, maybe this time sample for them. Or if you normally only request confirmations that are positive, maybe this time request negative confirmations. Also increasing the number of locations to be included in the scope. Since there's, like in that other example, 9 subsidiaries, maybe when they did the group scoping, they only scoped in 4 companies. Maybe this year scope in 5, or change the 4 that you scoped in previously and scope in another 4. Cool. Then when we talk about the risk of material misstatement at assertion level, we are then speaking to specific financial statement line items. Your assertions are broken up into classes of transactions and account balances, and you can find them in ISA 315 revised. And then again, when it comes to assessing, ask yourself, can I pinpoint a specific line item? If yes, it's assertion level. If not, financial statement level. Okay, I've spoken about the classes of transactions and account balances. Then significant risks need to be treated in terms of ISA 240 and ISA 550. Those are important, so you should flag those as well. So what are assertions? When we give an audit opinion, we are saying that the financial statements are free of material misstatement, either by fraud or error, and are fairly presented in accordance to the financial reporting framework. Management then comes and says, we assert that because we have internal controls, our transactions are accurate, they have occurred, they are complete, they are correctly classified, and they are recorded in the correct accounting period. An assertion is a claim that management is making. So that's basically what it is that you're auditing. You are auditing the claim that management is making about their financial statements. Assertions for classes of transactions. Occurrence, meaning that everything that you've recorded has actually occurred. Completeness, meaning that you have recorded everything that should have been recorded. Accuracy, that you have recorded those things appropriately. So if it's revenue, you've removed the VAT from the revenue. Cutoff, that everything has been recorded in the correct accounting period. Classification, that you've put it in the correct accounts. If it's depreciation, it should sit in depreciation. If it is stationary, it's sitting in stationary. Presentation, that everything that you've presented is in accordance with the disclosure requirements of your financial reporting framework. Then assertions about account balances is existence. So all of your assets, liability, and equity that you've got on there, they exist. The rights and obligations. Remember, we spoke about statements having your name on it. Do you have the right to it if it's a debtor statement? Do you have the obligation if it's a creditor statement? Completeness, meaning that you've recorded all of your assets, liabilities, and equity. Accuracy, valuation, and allocation means for your account balance items, your initial recognition was accurate, your year-end closure valuation is correctly valued, and that the residue from your valuation has been correctly allocated. Does that make sense?
Please repeat it.
Okay, look at PPE, right? You've got PPE, you want to buy a vehicle. You purchase a vehicle. When you purchase that vehicle, IAS 16 says you have initial recognition at cost, right?
Yes.
Then it tells you all the things you can include in your cost, and it tells you all the things that you cannot include in your cost.
Oh.
So you assert that when I recorded it at cost, I only included the things that can be included in the cost. And so my initial recognition is accurate. That's the accuracy part, right?
Yes.
Then we understand that property, plant, and equipment changes value. The value that you had when you bought it is not the value that you have in a month from now, right? Or 2 months from now, or at the end of the year.
Yes.
So you need to value it. How do we value something that has been recognized at cost? We depreciate it, right?
Yes.
So in terms of depreciation, I am saying that I've depreciated it correctly, and my accumulated depreciation against my cost correctly shows the net book value, which is my valuation. My assets are correctly valued, meaning the cost goes against the accumulated depreciation, right?
Yes, yes, I agree on that one. Oh.
Then in order to get the accumulated depreciation, I had to recognize depreciation. But the depreciation is not necessarily sitting in the balance sheet. Where is it? It was allocated to the income statement.
Oh, allocation adjustment. Now I
There we
see
go.
it.
And then if you have property that is not recognized at cost, but it's recognized on the revaluation model, that allocation won't go to the statement of profit or loss. It will go to the statement of other comprehensive income in accordance to IFRS 9.
And there's where allocation of adjustments still come in.
Perfect.
Ah. Okay.
Okay.
Now I get it.
Okay, I'm glad. I'm going to move on. Classification, that your assets, liabilities, and equity are correctly classified. That also speaks to your current versus non-current, because that's also an element of classification. And then presentation, again, in terms of the standards, are you presenting your stuff in accordance with what is in the standards? Any questions on the assertions? Okay, let's do a quick quizzy. Kite Flyers makes and sells kites. The company imports some of the components from India, which are invoiced to Kite in dollars. A standard costing method is used to cost the kites. What are the risks at assertion level? Quickly, let's do 2.
I think there's a risk that they used the incorrect exchange rate when they, to exchange from dollar to rand.
So for the inventory balance, what is the assertion that is at risk?
it's valuation or accuracy. Yeah.
Accuracy, valuation, and allocation.
Yes.
Perfect. Next
Yes.
one.
Another one we could-
The second one is right assertion. So the company may recognize the inventory when the risk and reward are not transferred to the company.
I agree with the risk of recognizing before the risks and rewards transfer because it's being imported. I don't agree with the assertion. Does anybody want to give me a different assertion?
We could also say that this is a different point. Standard costing is a bit complex, so the accuracy of the kites may be wrong.
That's correct. It might not be correctly valued.
Might not be correctly, yes, allocated value. Yes.
That's correct. Who wants to give me the other assertion for the premature recognition of the inventory?
Can it be existence?
It is existence. Thank you. It is existence. Okay. Audit strategy and audit plan. We're almost there, guys. We've done the planning. We're now in those two phases where we're looking at overall audit strategy and developing an audit plan. So planning consists of your overall audit strategy, and your overall audit strategy speaks to your overall financial statement level. And then you have to plan a little bit detailed. So you go to an assertion level, and that is your audit plan. So remember, you've got an audit strategy and you've got an audit plan. Your audit plan is interchangeable with your audit approach, but the one is more overall and the other one is assertion level. And that is because your planning needs to match your risk assessment. Your risk assessment was done at financial statement level, so it was done at an overall level, and then it was done at a detailed level, which is your assertion level. Audit strategy is a response to your financial statement level, so it's a lot broader. Please take a look at ISA 300 paragraph 7 in terms of the scope, timing, and the direction of the audit. Audit strategy has many components. So you can decide you're going to do a combined or a substantive approach. You're going to consider the impact of a higher risk. You're going to decrease your materiality. You're going to test more substantively. You're going to increase your sample sizes. You're going to incorporate unpredictability. You're going to exercise professional skepticism. All of those things are things that you would include in your audit strategy. You're going to get experts. You're going to perform testing towards year end. You're going to use less reliance on management representations, etc. In terms of developing an audit strategy, again, Appendix 1 of ISA 300 gives you some examples, but the 4 pillars that are covered is the characteristics of the engagement, your reporting objectives, timing and the nature of communications, significant factors, your prelim engagement activities, and the knowledge gained on other engagements. Those are things that you would incorporate. Then the nature, timing, and extent of your resources. So when you are planning your audit strategy, you're going to center it around those things. When it comes to your audit plan, which is the more detailed one, and it also fits into your audit strategy, this is where you're trying to reduce your risk to an acceptably low level by obtaining sufficient and appropriate audit evidence, which is where you're doing audit at an assertion level. Again, just another emphasis, very important principle, guys, that the overall financial statement level risks are addressed at an overall audit strategy level, and your assertion risks are addressed at or addressed in your audit plan. Your audit plan can either be a combined approach. A combined approach is where you test controls and you do substantive testing, or you can go a fully substantive approach, which is substantive test of detail and or substantive analytical procedures. Developing your audit plan, you need to look at the nature, timing, and extent of your procedures. The nature talks about whether you're going through a combined approach, a test of controls approach versus the substantive testing, or the substantive detail versus the substantive analytics. The timing talks about when in the year you're going to perform your audit procedures. Are you going to do procedures before year end? Are you going to do procedures closer to year end? So something like a hard close, if you guys have ever been part of those kind of audits. Are you going to do interim testing? Also incorporating an element of unpredictability in your timing. So if maybe you're going to observe a stock count, at which point in the stock count are you going to arrive? Or if the entity counts stock at the end of every month, which month are you going to go and attend the stock count? Are you going to attend the stock count during the year and then again at year end? The extent would be driven by your risk assessment. The higher the risk, the more work you perform. The lower your materiality as well, the more work you perform. Sample sizes are also driven by materiality, and then also the nature of your control environment. If your control environment is not sound, you will test more substantively because you won't rely on controls. Any questions on nature, timing, and extent? Okay. So audit strategy versus audit plan, just a quick breakdown. In your audit strategy, you're looking at the scope, which is an overall thing. You're looking at the timing and the direction of your resources. And then on an audit plan side, you're looking at the nature of your procedures. Then you're looking at the timing of your audit procedures and the extent of your audit procedures. So the difference here is that in your strategy, you're looking at the resources, and in your audit plan, you're looking at your audit procedures. Then your overall audit strategy is a limited overall response on your audit, and your audit plan is a detailed response which is specific to the audit. The responses on your overall strategy would include engaging experienced staff on the audit, having a lower materiality, placing less reliance on management representations, and applying professional skepticism. On the audit plan side, your response would be following a substantive approach instead of a combined approach if you've got a higher level of risk. Any questions on the audit strategy and the audit plan before I move to materiality?
May I ask on the question when say develop maybe the audit plan, so somebody say the nature, when they say the nature, and then I go to the type of audit procedures that need to be performed, obvious by looking at the business environment, the controls and everything, and then I decide that okay, maybe the business is gonna use the combined approach because the controls are proven to be efficient, so it's gonna be test of control and substantive. Do I have to list the procedures that have to be performed when I'm developing or should I describe the procedures?
No, unless they ask you to include the procedures. What you would discuss is the possibility, the necessity, and the desirability of performing controls.
Oh, okay. I think as I practice more question, I would be.
You'll see the layout. You'll see the layout.
Yes.
It's just unfortunate, sorry guys, because the class is not a very long time and they've put a lot of info in this thing. It's very important that you guys go back to your ISAs as well, to fill up more on the things that I've not included. I mean, we're not doing good on time, and I'm trying my best to put everything in here and also give you guys the important stuff, or the things that I think are important at least. I'm not your lecturers, so I don't know what's going to be in your papers, but I think this is very important. Cool. Any other questions? Okay. Materiality. My class spokesperson is gone. Anile is gone. Okay, so we all understand that materiality is a concept that comes in when we look at the objective of an audit, right? Because the objective of an audit is to ensure that the financial statements are not materially misstated. In order to know that they're not materially misstated, you need to know what material is. So when it comes to materiality, you need to understand the concept of a planning materiality versus a performance materiality. You also need to identify appropriate thresholds to base your planning materiality off of. You need to also be able to calculate, it's actually determine, because the ISA says you determine materiality. And then you also need to criticize a planning materiality, I suppose, determination. Okay, so materiality has planning materiality, performance materiality. Planning materiality is in the planning phase and it's affected by risk. Performance materiality is materiality for a specific class of transaction, account balance, or disclosure. Performance materiality is also something that affects your sample size. Performance materiality also represents your maximum potential error from your sample size. We call it a catch-all, so it's the net. And your performance materiality is less than your overall materiality. And you use performance materiality to scope in accounts when you're doing your scoping. In terms of determining materiality, the ISA does give you, yes.
Can we just go a little bit back on the difference between performance I wanted to ask, on planning of materiality, is it like the overall, like this is what I planned, the materiality is like the overall, like all financial statements and income statement type of thing, or it's just also will you please explain that more, please?
Okay, so performance materiality is cut from overall materiality, right?
Okay. And the planning?
Your planning materiality is what you determine in your planning phase. So your overall materiality, remember at the end of your audit, you also reassess the appropriateness of your materiality. At the end of your audit, your materiality can change. Your overall materiality is sort of your end materiality. But your planning materiality is the materiality that you determined in your planning phase. That's why it's called planning materiality.
And does it affect?
It doesn't always differ from overall materiality, but it can differ from overall materiality.
Wait, can you please repeat that sentence? I want to write it down. It
doesn't always differ from overall materiality, but it can.
Okay. No, now I see it. Yes. Now I understand.
Unathi, is it safe to say, like, in accounting terms, you can say it's a budgeted materiality and actual? Because like
budgeted materiality.
No, I'm just saying it's like in accounting terms, you can say it's something that is budgeted, like that it's planned. Like you are planning.
No, it's only called,
that is actually
planning materiality. It's only called planning materiality because you determine it in the planning phase.
Yes, and then the other one is during the actual, like the
other one is at the end of the audit.
Yes, it's based on the actual facts.
Yes. So remember, at the end of your audit, you do your concluding reporting and your evaluating, concluding, and reporting. Sorry, you do your evaluating, concluding, and reporting at the end of your audit, right?
Yes.
Part of that is to confirm the appropriateness of materiality. So now you want to say, I take a step back. I've performed this audit against this materiality. With all of the misstatements that I'm seeing, do I think that the materiality that I determined is appropriate? If yes, then my overall materiality will be the same as my planning materiality. But if I sit back and I say, no, actually materiality should have been lower and we should have actually performed more testing, or materiality should have been higher and we should have performed less testing, then your overall materiality will differ from your planning materiality, because overall talks to the overall report. Like at the end of everything, this is the overall materiality.
Yes.
So that's why I say, sometimes it differs from the planning materiality, but not always.
Okay. Thanks, Nati.
Right. Okay, so the ISA gives you the parameters and the thresholds and the benchmarks, that's the word I'm looking for, the benchmarks to use in terms of determining materiality. From an exam technique perspective, you would need to look at, your current year TB, current year forecast, prior year audited results, budgets, whatever numbers they are giving you, you decide which ones are the most appropriate to use based on the scenario. Then you consider the nature of an entity. Are you going to use revenue? Are you going to use gross profit? Are you going to use profit for the year? Are you going to use total assets in order to determine materiality? Then you're going to look at the ranges that you're going to use, which is the percentages. Then you're going to determine materiality, and you just provide a brief motivation for why you've determined that to be your materiality, as well as a conclusion. Any questions on determining planning materiality?
It's clear.
Okay, perfect. That is the end of our class. So thank you to everyone for attending. I hope you guys have found value in the class. Please remember. Yeah, sorry.
Thank you very much for the session. It was very helpful.
I'm very glad. I hope to see you in tomorrow's class. Please attempt the question and come to class with questions.
The questions, where do we get the questions? Or
please liaise with the online team, with the caretaking team. The caretaking team should be able to point you in the right direction.
Oh, okay. Thank you very much.
Okay.
Sorry, where can slides?
Sorry?
Where can we get the slides of the lecture you just gave?
The caretaking team will be able to assist you with that as well. All admin related questions, the caretaking team will assist.
Okay, thank you very much.
Thanks,
Okay. All right.
Thank you,
Thanks, guys. Have a good
Thanks a
evening.
lot.
See you tomorrow.
Okay.
Bye.
Thank you. Bye.
Bye,
guys.
Bye.
Night.